Hey, welcome to the Aramir Roundtable. Today's the 22nd of March, 2023, FOMC announcement day. So everybody's just watching the market. But pleased to have Wayne Klump with us today. He's going to be talking environmental trading edge stuff. And Wayne's got a good service over at his new site and still runs the sleep well over at Aramir. I've been working with Wayne now for, I guess a year and a half plus, and always a pleasure. Wayne's extremely knowledgeable, especially with how environmental things like all the FOMC stuff are coming out today, how that impacts the market and how he trades, and a little bit different take on how most people do things, but different is good. So Wayne's getting great results, and happy to have you here, Wayne. Welcome.
Thanks, Tom. Thanks, Tom. It's always a pleasure. I love the group here at Aramir. I mean, everyone here is just such high quality. So it's really nice to be here again and talk to all of you guys. And some of you guys, actually, I recognize some of the participants were a part of the Zero DTE workshop as well. And so such great information that's here at Aramir. So I'm really happy.
Yeah,
And with that, I guess let's crush right into it, huh, Tom?
you got it.
All right, so today we're going to be going over, a little bit of some basics for environmental options and things like that. But before we get into all of that, we've got to get through the legal part of things. So let's crush out this disclaimer. So I myself, Environmental Trading Edge LLC, and Aramir are not broker-dealers, financial advisors, investment advisors. Past performance is not indicative of future results. Options, futures, and currencies involve risks and are not suitable for all investors. Please talk to a financial advisor for any financial decisions. This is for educational purposes only. Now, with that through, we are going to kind of dive right into it. Tom kind of already introduced me a little bit, but just to give you just a little bit of a background, just in case this is your first time meeting me, my name is Wayne Klump. I was a strategy developer and professional options trader for a small hedge fund, and I did some work for some private firms as well as far as options strategy development and hedging. I am here an expert at Aramir. I run the Sleep Well portfolio service and the Awake service, which is a macro-driven portfolio that had to turn really well, actually, before this recession, and has been navigating it and outperforming pretty much all major indices. So we've been doing really well. Also, I am the managing partner at Environmental Trading Edge LLC, which is where the options portion of things come into. So just, because I was a professional options trader and more so on the professional side of things in a hedge fund, I wanted to kind of bridge that gap that I saw between retail traders and what I saw on the professional side of things with risk management, environmental metrics, and getting things into where they're consistently done over time. And we'll talk about that here on the next slide. So, this is a question that pops up in the retail land a lot, I feel like. And it's this kind of, what happened? We have, a trade that we're running for so long, and it's, there was this time that condors were the thing. I don't know if any of you guys studied or remembered, the late 80s and 90s when condors were like the rage. And, just everyone had got their new Black-Scholes model and all sorts of things. This is kind of how the market works in general, is that we have certain trades that come in favor and then they drop out of favor. And then we have different flavors of them. And we go all the way from, oh yeah, we're premium sellers and theta sellers to volatility sellers. And now it's straddles. And, this is what's the new hot trade right now. And this is really common in the retail world. And this is, it's even common in the professional side of things. So don't for one second think that on the professional side of things and hedge funds don't fall into this trap. In fact, there's many hedge funds that blew up in the Volmageddon, as we like to call it, back in 2018, and it's a trade that has worked for a little while and has worked really strongly, and then eventually, blows up. And what ends up happening is as edges start to erode and as things start to change in the market, a lot of the times we'll hear about new strategies that'll come out, or this is the new hotness, and we get ever more complex types of structures and adjustments to manage these risks of these dying edges, right? Or maybe they're not dying, but maybe they're just, falling out of favor just a little bit, and there's just a little extra risk in it, and it's temporary, right? A lot of the time it's temporary. And in fact, if I could sit there and, kind of draw out what the cycle looks like, let's just say that we've got a trading system that goes in and out of favor, right? And it just kind of cycles like this, right? Let's just say it goes in and out of favor, right? And overall, in general, maybe it's, trending up, maybe a little bit more than what this shows. What happens for us as just, humans in general is our attention gets pulled in right around here on every cycle, right? Even right around here on every cycle. And even in the beginning here. So something becomes really hot and everything's really getting good and the performance is really high. And then what we do is we kind of get sucked into it. We scale up, we, leverage up, and then it starts to fade, right? And it starts to lose. And then because we scaled up, we take extra losses, and then we get pulled down, and then we go, no, I'm never doing that again. And then we kind of flatten out, right? And this is the typical cycle. And then we flatten out and we're not part of it. And then all of a sudden that strategy becomes really hot again, or that structure becomes really hot again. And we've been hearing about it and people have been doing so well. And then we jump back in it and, we took hits on it before. So now we really need to ramp up. So we really leverage up and we go through this whole cycle again. We're really, really ramping up. And then all of a sudden, because we ramped up, now it goes out of favor. And oh my God. And now we start to take all these losses. And now we're back down in this cycle. And we're like, we're never doing it again. And then we quit trading. So that is a really horrifying thought of how this normally happens as far as how this cycle goes. But we can actually navigate this in a little bit of a better form. Could you imagine if we could sit there and say, hey, somewhere around here, we know that this strategy is going to fall out of favor for a while. And then somewhere around here, we can tell, hey, this is starting to come back in favor. And what that comes back to is a fundamental driver of that strategy, and also navigating the current market environment and making sure that we are dynamically adjusted to the market. So let's kind of look at a couple trades and let's see if I can explain this a little bit further to where it makes sense. So here's a random trade that I just, threw out here, right? I'm just kind of randomly throwing butterfly with some calls on here, trying to get down to 0 delta. You can see I'm all the way back in 2017 here, right? In about September of 2017. And in general, you can see down here that I've got this butterfly structure behind the market. I've got some calls way up here at 1 standard deviation. And in general, we are here at 30 days. And we are also, you can see here, we are 1, 2, 3, 4, 5, 6, 6 strikes wide, but of course we're on 5-point increments. So we'll kind of loop back to that in just a second, because that's going to be an important factor as we get deeper into this. So in this particular, this is when, this strategy might have been the super hotness, right? And things like that. And so we were putting it on, but let's see how this strategy performs over this coming move. And I'm going to totally, break the anticipation here. The market is going to go up, by the way. So let's kind of see how it performs. So the market starts to go up, and it's actually going up pretty aggressive here. Just so that you know how aggressive we went, I'm just going to kind of zoom back here. We started out at 2507 here, and we are going to march up to 2519. Now that might not sound like a lot, because in today's world, and as far as right now, that was not a big deal at all. But you can see back here per its volatility at the time. That was about a 1 standard deviation move. We're moving up. That was on that daily basis. And you can see here that the IV, or the implied volatility, is only at 5.57. So this is a very, very low volatility historically, right? And of course, right now, just to give you a little bit of reference, in 2022 and 2023, we've been necessarily averaging, in the low 20s. So significantly different. So this market really shouldn't move much. And we're in a strategy that is baked in for a lot of movement, right? We're like, hey, we want this thing to go way up here or way down here. Anyways, let's see how this strategy keeps performing as the market goes up. All right. So we've now had a rip-roaring rally. We are now significantly higher on this situation for the amount of volatility. And you can see here that it's just done a whole lot of nothing. And it's just sunk out, and it hasn't performed, and it's just not a worthwhile trade. In these moments, especially when this trade is wrong and the market doesn't actually go up or down, you just get this sink out, and over time, over and over and over again, you start losing money. And that's when typically we would fall out of that cycle. So you remember that cycle that we were talking about, right? This is when this strategy is on the death sentence right here, right? Okay, let's take the same setup, right? And we're here now in January. So we're just a few months down the road, right? And we are here in January of 2018. And you can see here, I've got pretty much the same setup. We've got roughly 6 strikes wide on our butterfly. And then we've got some calls up here at 1 standard deviation to the upside to get us down to a roughly 0 delta. So we're taking pretty much the same trade. And I cherry picked this situation. I'm just going to give you that for like on the front end. I cherry picked this situation in a sense that the market goes up at almost the exact same pace that the other one does. But we're going to see how this one performs instead. So the market starts to go up yet again, kind of slow, just kind of trudging up. But ironically, we have no sink out right here. Nothing has dropped out of this trade at all. Same structure, right? And it's almost kind of like magic to the unknowing person. It's like, whoa, this strategy is working so well. And what happens is it starts to grab our attention again, right? And let's see, as the market continues to go up, we get even more lift, right? This market has still gone up on a relative basis, roughly about the same. Our starting IV, just to go back here, our starting IV was roughly around that 6 range as well, right? So same amount of IV in here. I just wanted to kind of talk about that. And now at the very end, right, as this market continues to roar up, we end up making lots more. But I want you to notice in this that there's a very dramatic difference from the structure that we had earlier, right? We now have over here, we now have lift across our entire T+0 line right there. We have no decay sag like we did before. So what happened, right? Why did the same structure perform differently in roughly the same market movement? And this is what I think catches a lot of us options traders off guard, especially when I was new at trading options. I would kind of be like, I traded the same trade. The market did the exact same thing. The market went up. It did this. Why did I win this time versus lose the other time? What happened? What could I have done prior to setting up this trade to know that it had a larger advantage, or as we, generally speak about in this business, it had a larger edge going directly into the trade before we actually put on the trade? And I think that that's kind of the magic, is making sure we know what environment we're in prior to even entering the trade in the first place. Before we jump in, before we start doing all these fancy adjustments to these trades and trying to manage risk because something went awry, we set up at the get-go with a good structure and a good setup based on the current market environment. But there's also other elements in here too, because what I've seen and what happens sometimes with us as traders is we even start to make these structures a little bit flawed in themselves. So if you notice, I had roughly six strikes wide in their 5-point strike increments, right? So these are, let's just say that they're roughly 30 to 35 points wide on our wings. Well, what if we were to go to a totally different environment, right? And go to something like what we are in today, or I should say last year, really, but this in general, our environment. So I'm roughly setting up the quote unquote same trade, right? And what I mean by that is I'm roughly 1, 2, 3, 4, 5, 6. I'm seven strikes wide. So like I said, about 30, 35 points. And now I've got to get down to 0 delta, right? Or at least as close to 0 delta as I can. So I have to put on as many calls as I can up here to get me out to 0 delta. So, per these rules that I kind of just arbitrarily threw out here, I said, hey, we need to put on a 35-point wide butterfly, and we need enough calls up there on the call side at 1 standard deviation to hedge out our delta. And let's, wipe our hands and call it good. And it's going to work forever. And 30 years down the road, it's never going to have a problem. Or in this case, just 5 years down the road, it's not going to have a problem, right? This trade, albeit quote unquote, we'll call it the same trade because it's per these same rules, will probably have a very dramatically different result in a market that goes up. So let's kind of see how this one works. Yeah, so the market went up a very large way and we are up no money at all, right? That's basically what ends up happening with these types of situations, is that when we don't set up our trades at the get-go to be dynamically tuned for the market environment, we end up having dramatically different trades than we originally intended. So we're going to talk about like just basic ways to environmentally tune a trade. And just for the get-go, let's like take our last example here that we just had. And one of the key things, and I think that this is just the most basic thing that we can do for environmentally skewing a trade, is to keep the structure sizing, right? Specifically the sizing and the adjustment points consistent per what the assets, volatility or ranges or size or things that will dramatically change the structure width of the trade. So in this case, I'm saying the asset's volatility, right? But you could use something like ATR. You could use something like, volatility, implied volatility, ATM volatility, whatever means something dramatic or, significantly to your trade. But this is a key thing, is we do not want to base things on points or delta, which we'll talk about delta more in just a second, because that might hit someone's nerve right now, or gamma or spread width, like I just said, or maybe even a static percentage point from ATM. I've definitely seen that. What happens with any of these types of things is you get what happens on this trade below here, right? We end up getting into a different environment, and now all of a sudden our trade is going to look and act differently than what it did in the past. And one thing I definitely want to push on here is that many times it's not as dramatic as what I'm showing here. It's a slow bleed of of a manipulation of our original trades. And then what ends up happening is we go, okay, that didn't work, but this new hot trade, which is now tuned to these recent results that we've had, is now the one, right? And really what it was it either switched its edge or it finally, tuned its size and everything to what the market is at this moment. And maybe it got its adjustments more in tune to what's going on with right now. That's what we typically see. And that's what happens with a lot of, retail trading, is that we sit there and we fall into these traps, and then we go and we let our buddies know and we let our friends know. And we go, hey, yeah, that trade that I told you was awesome. Well, I had to kind of tweak it a little bit. Well, why did we have to tweak it? We tweaked it because the market changed, the environment changed. And in order for us to be consistent, we have to be consistent with the environment. So let's kind of, just tune this trade per what the market's ATR is. And if I were to tune this trade, you can see here, and what I did, I'm going to explain what I did here. But when we did this, you can see now we are dramatically larger than a 35 point wide, right? We're going from 39.45 all the way down to 38.20, right? That's a much larger butterfly than we had in the previous example. And what we did is we anchored to the volatility of the specific expiration that we're in. Now, the way that I do this and the way that I talk about at Environmental Trading Edge is that we do this based on, the standard deviation of that expiration. It's kind of the easiest way to just simply grab it and chunk it in, and it works relatively well historically. There are other ways to do this as well, but I'm just explaining to you how I tune these to just keep it really simple for everyone. And so what we can do here is we can go all the way down to where this one standard deviation is, kind of like what we did on the call here, where we went right to where it changed. And we put our longs down there. We can put our shorts halfway in between, and then we can put our longs ATM. And what that'll do is it'll tell us, roughly speaking, what's a pretty close to optimal butterfly in that environment, in that expiration, right? And it'll dynamically adjust itself to changing volatilities, changing ATRs, changing biases in the market, things like that. It'll dynamically shift it, which is really nice and helpful. It's a very simple, clean way to just make it to where a trade doesn't break down because of a spread width issue, right? Then, of course, the calls already were dynamically adjusted, because that's how this one, it was like half a dynamically adjusted and half the other. And you can see up here that we were at one standard deviation anyways. So that was already stretching out to the market, and it made us put calls way up here anyways. Now you notice that we weren't necessarily looking for a specific price of an option or even a specific delta of an option. There are pros and cons to those types of things. But if you ever just want to kind of like see if one of those rules were to make sense, you can always go on a different asset that's a different size and go and try to set your trade up on it. I like to go to the NDX because the NDX is larger than the SPX, and just see if some sort of rule that I use, if I put it on over there, would it make the trade, look, feel, act different than it was in the SPX, right? So now that we've got this type of situation, you can see pretty dramatically that it looks like our older trades. So this is the older one, and I know that the dates are really small here because I made these images really small, but we're just trying to look at just in general what the shape is and how it looks per the time. This was our original trades back in 2018 in January when things worked really well, and here's our trades now. And you can see overall, roughly speaking, they look the same. That doesn't mean that it's still going to be a good trade by any means, because it is a different environment. And why is it a different environment would bring me to a second point. So you have this type of situation where we've got this call up to the upside, and we are going to, by the way, I just wanted to show how different this trade is, right? The trade that we now dynamically tuned, as opposed to the very wrong one that we originally had. So another step for tuning for the environment is what I call this kind of delta dilemma, right? And so we're going to talk about, because there's a lot of trades that I've seen, I've come in contact with, and even have, individually talked with traders that use delta and really anchor on this whole, well, I don't want to take more than 10 delta, or I don't want to take more than 200 delta, or whatever size they are, right? Per their, quote unquote, one lots or something like that. And this happens a lot, right? Delta is something that stays relatively static for a while, right? It's a slow breakdown. But let me explain what the delta dilemma is, right? So the delta dilemma, let's just take an asset that has 1,000. By the way, 1,000 is, I think, what, roughly what the S&P was back in like the bottom of 08 or something like that. Don't quote me on that, by the way. I'm just kind of putting some reference, right? So the asset size is 1,000, right? And let's just say we get 1% of movement, right? 1% of movement is, that's an average day right now. I think we're getting 1% movement pretty regularly. Well, if we have a delta, that's our anchor, right? Our delta of 100, then roughly speaking, that 1% move is going to cost us or make us about $1,000. Perfect. Great. And let's say that works fine, and that's all fine. But over time, assets go up in value. As you guys definitely know, from 2008 to now, the S&P is significantly larger. We probably used to be nearly about 1,000, and now we're at 4,000. So we're 4 times as large. So let's kind of push this to an nth degree, right? So let's say that we've got the asset size of 1,000 or 100,000. Now that we've got an asset size of 100,000, and we take that same 1% move, roughly speaking, just a normal day, right? And we still have that same delta of 100, right? That's the point. That's what we anchored on. We anchored on that 100 delta, right? The thing that's changed, though, is another factor of the environment, which is the asset size. So not just, this is why it's so important to have our structures environmentally tuned to the asset price, size, volatility, all the things that matter to us in our trade. Because now at 100 delta with that 1% move, we are taking significantly more risk, right? Significantly more. And you might say to yourself, well, yeah, but if that were to happen, I'd tune my delta back, right? Absolutely. You probably would, because there's no way you'd take $100,000 worth of risk, per that trade. It wouldn't have made sense. But the thing is that I'm using a huge dramatic example going from 1,000 to 100,000. But when we just tweak it just a little bit, what if we have a 20% growth in the asset? So we go from 1,000 to 1,200, right? What would that do? Well, we are technically taking 20% more risk in that situation per the asset size, right? But would we be taking 20% more? Well, this is where it kind of hides for people, because what happens is if the market or the asset goes up by 20%, and let's say we're now at 1,200, well, what happens is the volatility typically calms down, especially with indexes and stocks and equities that most people trade options on. And what'll happen is that 1% move that we were having when the asset was at 1,000, will now be something like 0.8, right? So now that we get a 0.8% movement, now what happens is the rough, how much the market moves on a daily basis will still keep us relatively even to that 100. So it doesn't start showing up immediately, but it does start showing up when you get a volatility event. And when you get a volatility event and we're now at an asset price of, let's say, 1200, and then we go back to the volatility that was at a 1000, now we really are taking that 20% extra risk. That 20% extra risk adds up, because if we are leaning on theta or leaning on some sort of Greek, gamma, something like that to help us out, and we start to take on extra delta risk, then our relationship for our delta to the edge that we're attempting to grab is going to slowly shift in the favor of being more directional. And it was completely unknowing to us because of what happened, right? It was slow. It's like the frog in the boiling pot of water. By the way, I just wanted to kind of point out here that the closer to zero delta, the less of an impact, right? So originally we were tuning that trade that we had just saw to zero delta. When we tune things to zero delta, we basically eliminate that variable as a whole. So keep in mind that going to zero delta isn't going to be a large of an impact, but is the further we get away from that 0 point, the more exponential the impact is on the trade itself, right? Because delta becomes a bigger factor as it gets away from that 0 mark. So it's an exponential relationship. Also, the more capital that we have, which some of you guys probably already know for sure, I do know that because the quality here is so high. But basically, using one lots or using consistent capital impacts delta, right? So if we, have a $50,000 account and we're looking for 10 delta, but then all of a sudden we have a $500,000 account and we're still looking for 10 delta, that's a pretty significantly different trade, right? Okay, so step 2, right? So our first step here was to keep our structure sizing and adjustment points consistent. By the way, adjustment points, that was something that I didn't put too much focus on. But if we're not stretching out our structure, I'm going to rewind just a little bit because I did want to touch on this just a little bit better. But if we are basically setting our adjustment points based on a static butterfly pricing or a static spread pricing, and the market goes up this much because the environment has shifted and our structure is no longer tuned to the size of the market, then we're going to be adding a lot more adjustments. And our adjustments they're going to happen more rapidly. They're going to happen way more than they used to. It's going to start turning into trades that we should have never been in per the just normal market movements that we're having, right? If we had an adjustment point that was supposed to be behind the shorts, right? That's something that's really common, is that we start having different rules behind the shorts, or we start using different rules when it's out the back of the butterfly, or we use different rules when we get to the call up here or whatever. If we have a static structure that didn't adjust to the current market environment, we can hit this intraday, right? Intraday, we can hit our shorts. And then all of a sudden now we're like, wait, it's a whole different trade. And then all of a sudden we're out the back of the butterfly and, oh, we need to scale up 50 times or whatever. It just changes everything. And then all of a sudden the market rallies later that day and we're completely supposed to be scaled out. And oh my God, what the heck, right? It starts to create this crazy situation because normal market movements are triggering everything. And it's because we didn't dynamically adjust our structure to the market. So delta dilemma, make sure our adjustment points are the same. So our second step for basic tuning to the environment, and I do want to preface here that I'm keeping things at just like the very basic level, right? I'm not going into very heavy, advanced things, even things that I take into consideration on our own trades and our services, which I'll get into later. There's a lot more factors that can go into environmentally skewing than just what I'm showing here. But the next thing and these are for all trades, by the way, if you're a swing trader or something like that, use one or more indicators or factors that fundamentally impact your trade, right? If we are a swing trader, right? Most swing traders perform better when the market is moving more, right? We get more volatility, right? So that's a fundamental impact of even swing traders. Now, as options, right, volatility is literally baked into the price of our options. So it's definitely a fundamental driver of our options, right? But so is price movement. So is lots of other things, so is macros. They all affect the options price and a strategy's performance. So taking into account what the volatility is, so here we can see here that we have a volatility of dang near 35 right here. This is just last year. So we take that into consideration. We say, hey, volatility is really, really high historically. Well, we take this trade, for instance, that is like, let's say it's here to grab market movement, but yet we're an options trader, right? So we're like, yeah, we'll do some gamma type trading here. Remember, volatility is stupid high right now historically, but yet price movement is also very high as well. And so I want to trade, big price movements. Well, let's see what happens when we get those quote unquote big price movements. All right, so we got these huge, gigantic price movements. And by the way, just to give us some reference here, we started out roughly here and we are all the way out to here. That was a move from 37.75 all the way down to 36.50, right? A very large shift. You can even see on this very day, we had a 2.5 standard deviation move. These are big price movements, right? We're moving 137 points in a single day. All right, but we didn't make any money. What the heck, right? Well, something that fundamentally impacts options is that if you're buying a whole boatload of volatility, when volatility is really freaking high, it's going to be a negative impact on your trade, right? So that's a fundamental driver of this strategy. And I know I'm using something simple, like as just a at the money straddle gamma scalp type thing. But let's start tuning something to the environment. So ironically enough, I am going to grab our old faithful that I just put up just a little while ago, and I'm going to use the same trade. But why did I use this trade? Well, this trade is selling a whole boatload of volatility where volatility is really pumped up, right? Now, you might sit there and go, well, yeah, but you're also buying a whole lot of volatility, right? I totally am. But there are other factors that are involved here other than just raw volatility. I'll go into that another day if I ever get around to that. But the point is on this is that we are still, quote unquote, actually looking for very large movements in the market. Now, I know that might be weird because when we're sitting here looking at this, let me find my pen here. Where is my pen? There it is. So when we are looking at this, we're like, well, that's not going to profit anything from a large move to the downside. But let's not be deceived by the T+0 line. Let's use what is an environmental factor in this trade, which is selling the aggressive volatility that is in certain portions of the options chain. And so we're going to sell a lot that's roughly in this area, right? We're going to buy a lot up here. We're going to set this out and not looking at the T+0 line. Let's actually just think for just a second. As this volatility starts to move to the downside, we're going to have a little bit of time come in. We're also here at 14 DTE, right? So there's such a large impact on this trade with the amount of volatility that we're selling per the time that is going to accelerate going into expiration. So let's see how this performs on that very same huge, large move. Boom. Now, instead of being not up any money, this trade is now up 19%, doing pretty nice. And guess what? Look across this entire T+0 line. Nothing sank out. Nothing got hurt. We literally just made money everywhere that we looked, right? And that was a huge, gigantic move. So it's very, very important for us to be environmentally skewed, changed, adapted to the environment. And that was just one example, right? So here's going to be my little push for our Adapt Daily service. So what we've done is we've taken these concepts of environmentally skewing things and turning it into roughly, just a systematic way of applying these on a daily basis and keeping them going like a rolling campaign, right? And we offer this as a service. So these are the trades that we're taking. My managing partner, myself and my other managing partner, Michelle Gray, has put this together and put it together on a website where you can track it. You see what our results are. If you wanted to follow along, you have that choice, and we can show the results. So as far as what the heck is the Adapt Daily? Well, currently speaking, we have 5 different structures. So you remember how I was talking about that kind of wave that we have where certain things go in favor and out of favor? Well, what if we were to have a totally different structure that was, in favor and out of favor when the other trades might not be, right? Now that we've got different factors, we can sit there and go, well, do I want red? Do I want blue? Or do I want green? Well, what's optimal right now? Well, right now, red is optimal. Right now, green is optimal. Right now, blue is optimal, right? So think about that as these 5 different structures, right? Which one's in favor? Now, what might happen is even though we might not have different, or we might have the same structure in 2 different environments, which happens very regularly, we also can't ask for the same profit and loss in every single market environment, because it might be a situation where, let's just take red, for instance. Red has a significant edge at this date, right? Let's just say it's this date. But over here, it is still the most favorable structure, but you can see it's got a dramatically lower edge. It's not as in favor, right? So you can see that that difference there is significantly lower than it was at its peak. Now it's still the optimal structure. It just isn't as strong as it was. So instead, we can ask for lower profits. So let's say instead of going for a 16% profit on that trade, we go for a 3% profit, right? And what that does is it starts to change things to where we're always in an optimal structure, but yet we're dynamically tuning to its historical relationship per the fundamental drivers of that trade. And, fundamental drivers, just to make that nice and simple, kind of like volatility is to the last trade that I showed. There's other factors, lots and lots of other factors that affect options pricing, and especially complex option structures. That was just one example, which was volatility. One of ours is a Reef. So just to kind of give you a general overview of what our structures look like, right? We have a Reef structure here. So it uses calls, and you can tell, like, in general, when you look at these, they're already, if you sign up for the service, you'll see that when you watch the first video that we talk about how to do these trades, you'll see that the rules specifically will dynamically adjust themselves to the market environment. So a lot of the environmental skewing is already just taken into consideration with how the trade is actually set up in the first place, right? So this one is a 14 DT OTM put butterfly. That all will make sense once you sign up and see the videos. And, you know, we've got 10-to-1 butterflies to calls. That's always important as far as how it's environmentally adjusted. We've also got a deep sea. A deep sea is different than a reef because it uses an in-the-money call rather than an out-of-the-money call. It also doesn't use calls to butterfly ratios. And then we've got buoy, which, you know, these are just names that we came up with. That way we can anchor onto what structure we're in, because these aren't necessarily in, you know, quote unquote butterfly or calendar or things like that, right? They don't fit into those categories. It's a very specific butterfly, right? So this one is actually a uniquely different than the other two strategies, because this one's all the way out at 14 DTE. That is, like I said, more environmental effects, the reason that we're out there. And you can also see that it's a call structure. That is the only structure that is not delta neutral, by the way. Most of our other structures, as you can see, are most of the time mostly delta neutral from the start, at least I should say. We also have the surf trade. The surf trade is a really fun trade. I like this trade. It's one of my favorites. It is a calendar-based trade. So instead of a butterfly and what we're kind of used to with butterflies, it actually is using our time premium element as a butterfly, and then it hedges itself off with a vertical. And then we've got a rope trade, which is basically a butterfly on butterfly trade. So it uses butterflies to hedge butterflies. As I said earlier, all of our trade structures are mostly delta neutral, except for that buoy trade. I can get into that buoy, you know, on an individual basis once you sign up for the service. If you have questions like, why the heck is that not delta neutral? And a big important deal with all of our structures is that they are no adjustment. So we have these, we have all these trades that we're putting on, but the point is that we're not, you know, trying to manage the risk of them as they develop, right? Because that can actually hinder a trade's performance pretty significantly. You adjust out, and then you adjust this way, and then you adjust that way, and then all of a sudden you're left with nothing at the end of the day. So that's already taken into consideration as well. Also, the way that the system is managed, which we'll talk about that. It can also make it to where that it adjusts itself, which is kind of a cool concept. So we enter a new trade every day, right? So that's literally every day. We're taking off a trade or entering a new trade every day. We check it once per day. And the reason why we can enter a new trade every day is because all of our structures roll for exactly 1 week, right? So we're 5 trading days into the structure, and we take it off, regardless if it's up, down, left, right, doesn't matter, right? We're just taking it off. It's a 1-week trade. We put it on for the market environment at that time when we put it on, and then its results will happen a week later. We'll have 5 trades on at max, right? So if you can think about that in general, the maximum risk that we can have in this is, you know, 100%, which is 20% in each trade. So environments, this is one thing that I kind of wanted, I get this question a lot, you know, how long do environments typically last, right? They can last about, you know, 10 to 15 days in a more chill market. As of right now, this market is flipping pretty quick from different environments. And so our environments are a lot shorter. They're sometimes only 5 to maybe, you know, 6 trading days or so. And we're switching into a new environment, sometimes as little as like 2 or 3. The most common structure we use is the Reef. That is probably a rather familiar looking trade for some of you guys here at Airmere. We have varying profit and loss targets. That's why it's so commonly used. But basically, it gets from looking for a profit target of all the way up to, you know, 20% to only looking for a profit target of like 3%. So it's dramatically different in different environments. Our highest returning trade is actually the rope trade. That's that butterfly hedged with butterflies. We just got finished with, I think we went 2.5 weeks, maybe less. It might have only been like a week and a half of just stacking on rope trades, one after another. And we had some very, very good returns. So this is a really fantastic little trade here when it's in favor. Our most unpredictable trade is the surf trade. And for any of you guys that have traded calendars or are even part of the intraday service that I run, the intraday calendars, calendars are just a little bit more unpredictable. We can set them up to where they are set up for a good environment. They're set up with good pricing. They're set up with good contangos. They're set up with good environmental metrics per the calendar, and still be wrong, right? There is a slight unpredictability, even with environmentally skewing things, that we might not be right. They can just drop out from underneath us, things like that. But that's kind of why, like I said, they're a little bit more unstable. In general, this is a very profitable trade. But you also, one thing about just kind of structural skewing, kind of like what we saw with the trade example that I showed up with the volatility, you can't necessarily depend on this T+0 line. Many times we will be profit target up here, and this T+0 line basically says that we're not even able to get to that point, right? Even with decay, all that kind of stuff, right? So definitely don't pay attention to your analytics graph. Sometimes it's more about the structure and in the environment more so than what the analytics graph says. All right, as far as like what you see when you join the service, we've got this metric here, and it updates every day, and you'll see it, and it actually updates every minute. So, sometimes it's very rare, but sometimes we're in a different environment in the morning than we are in the afternoon. But anyways, always kind of stick to your time trade, or your trading time, I should say. And you can see down here, you can see what its current profit and loss targets are, right? 14 and 13 was what it was back on 310. And then I always have risk level ranges. So, I come from a fund. So, and on the professional side of things, you should always have an allocation to your trade, right? Something based on your net asset value, or your, what your account size is, how much risk you're wanting to take. And so what I do is I break this down into different levels. So there's level 1, level 2, and level 3. And basically, if you're wanting to stay at the lower level of returns, right, and lower levels of risk, you can see down here, basically taking on a 44% CAGR, which is compounded annual growth rate. And our max drawdown historically we've seen so far has been about 4%. And that would mean that today's Reef that you would be doing up here would be 3%. So let's just say, just to make things nice and even, I've got 100K. And if I was making this trade today, I'd set up a Reef, right? So let's say I set up this little Reef, and it looks roughly speaking like that. I would make sure that the amount of contracts I'm using that day is close to, roughly speaking, $3,000. So that's how you use that kind of allocation down there. And like I said, the max risk is level 3, and you can see that it maxes out at 20. So depending on the environment and depending on how much edge a structure has, it will reduce its allocation. So you can see it wasn't a very strong edge back here on 310. And when it gets a higher structural edge and higher performance, that allocation will max up. So not only are we dynamically adjusting the trades themselves and the structures and the profit and loss targets, but we're also dynamically adjusting the actual risk taken per the environment as well. You can always see, how to make the structure, right? What is it? A little bit more details. There's those resources on our website. And of course, I know what all of you guys are probably asking, well, what the heck are the returns? How have you been doing? So that's what we've got here. So we've got, we were testing this prior before we opened it up to the public. We opened it up to the public just here recently back in February. But basically, we were nice and steady all the way from back in November. And then we actually had a little break here. I'll talk about that here in just a second. But that was our little drawdown. And then we basically bounced right out of that. And here recently have been having a stellar time. So live results wise, we're roughly speaking around 45% since when we began testing this in alpha phase. So what about that little break that I just mentioned? Well, there are times, you remember that cycle that I was talking to you about, right? Where you have these trading edges, right? These trading structures that come in favor. And I'm just going to draw out a few of these right here. And if I've got trading structures that have certain levels in it, but what if I had a situation in which, say, this was my bare minimum, right? So my red line is, let's call it my zero line. I need to have a trade above the zero line in order for it to be a profitable trade, right? And you can see down here at the end, right, that there is nothing above the zero line as far as these wave patterns that I put on here are concerned. So there are times that there are literally no trades. So that's what we did. We took a nice gap and we said no position is a position. We'd rather be in cash than lose money, right? No need to trade if we don't need to. And so that was that nice break. Now, of course, after that break, when we got into an edge again, clearly it was a very strong edge and we had lots of nice returns very quickly. Here is our breakdown of our trades as far as what they've looked like recently. So that way you can just for yourself see exactly how everything is. You can see things that are recently open as far as that is concerned. And you can see what our performance has been. We took our little $100,000 account and we have now grown it since we released this to the public. So this is not all the way back in November, but since we released it to the public, and that was to our members over at the Trading Edge since 2/6. So roughly speaking, within about, month and a half, let's call it 7 weeks or so, we've done almost 30% now. So it's been really nice. We have also done that with only drawing down about 5%. So very, very strong risk rewards as far as that's concerned. Now, as far as live results versus back tested, this is always the other question is like, well, yeah, but what does it look like in history? How, it's, yeah, great. You've got recent live results. And this is something that I feel like I always want to give people as far as like, we have to know how this has performed historically so that we know how stable it is. What's its max drawdowns? How do we know it's in a problem, right? How do we know if the structure, or if a trading system is breaking down, whatnot, and so forth? So you can see our recent pullback that we had back there. This is all live in orange. So this is all live results. And everything back prior to that is synthetic results. Now, just to kind of put this in frame, I've been, any of you guys that are part of the Adapt Advance, which is a totally different service than what I'm talking about right now, but you guys know that I've been trading like this for a long time, using different structures, different setups. And so I know that these edges are very sound historically for even longer than what this data set is concerned. And we are actually getting more data. So we'll have, we'll get longer back testing data in here very shortly as well. Anyways, just to kind of put in reference here, we've got lots of things in this data set. So you can see here that we have pre-COVID, we have actual COVID itself, we have post-COVID, we have, there was some kind of crazy, bubblicious things in 2020, a few things. We have the super crypto bubble of 2021. Then we have the transition in 2022 here and the subsequent, nasty first part of our recession. And that goes through all of that. And, the main thing to kind of look, I feel like the main thing to look at here is just how consistent we are, right? You can see that even though we're changing different structures all the time. Literally, we're switching from, ropes to buoys to all sorts of different things, right? Surf trades, completely different structures. We have very consistent returns that are very nice and steady with very consistent risk. It doesn't mean that we don't take risk. Here's probably one of our longer drawdowns, right? So we definitely had a couple months of no returns or negative returns. And then, of course, we have, 3 months or so of positive returns and things like that. But they're very consistent. And what's nice is that they're not deep enough to necessarily set us back years. So that was something that back in the day with, there were some other theta-based trades back in the day, pre-Volmageddon, that were really nice and consistent for a very long time. But then if you took some of those hits that happened in Volmageddon, they set you back years of returns because of being sized up and scaled up and all that stuff. By the way, this is compounding returns as well. This is not static returns. This is as we have more returns, we scale up our trade sizes. As we have less returns, we scale down our trade sizes. So this is a scaling structure for any of you guys that are asking that attended my the zero DTE workshop with my section of that. And as the last and final small little push here, I will tell you guys that you can go over to our environmentaltradingedge.com/daily adapt purchase page, and you can go directly there. And for you guys that are here on this roundtable and attending here at Aramir, you guys will have this offer that is 50% off for your first 3 months. So our 3-month subscription service is $375. Of course, you can still sign up for weekly if you just want to have a 1 week free trial or something like that. But for a 3-month, you get 50% off, and you have to use the promo code on your checkout round table. So now I saw that there was a few things in chat. Tom, do you want to take that on and see what questions there were?
Oh, I think most of it's around the FOMC announcement as a quarter point rate.
Yeah.
Let's see. Bob asked, why do you say you have P&L targets if you say the trade is taken off after 1 week, regardless of what's happening?
Why do we have P&L targets? Because sometimes we can take off the trade early prior to the 1 week and take off risk off the table. That actually happened to us recently with the rope trades, just to kind of give you a little bit of frame of reference. But we were stacking on, we had 5 rope trades on at once, but they started to all max gain. And so what happened is we took off about 3 of them, I think, and only had 2 ropes on for the transition into what eventually became a downturn, actually, and that market pullback and everything like that. So we had significantly less risk on the table. So we were able to capture our profits. So it's all about keeping as much profits as possible and not giving them back to the market. And that goes back to the environment as well, because sometimes it's not a good thing to let a trade run for too long.
I don't see any more. Oh, wait, here's another question for you. You see it?
Oh, yeah. So what's the minimum account size to trade for the daily option strategy? Yeah, the dailies. So you can tweak these things down into something smaller as far as trading with the SPY for the calls and for some of the verticals and stuff like that. And technically speaking, you can put the butterflies on the SPY as well, but just know that you're going to have some exercise issues and things like that. So you can trade very small if you're working on practicing and you're going to have commissions, erode a little bit of your returns, and watch out for exercise on the SPY. But if you're going full SPY, you can definitely get down into the $25,000 to $5,000 account size if you're trading all SPY. The smallest that I like to do with the SPX is about 20,000, roughly speaking, because you're cutting it all into different increments, right? So most of the time you're anywhere from 2,000 to 3,000 per lot I should say, And then you can definitely size up significantly larger than that. If you're all SPX, if you're going to 100% run SPX, then definitely getting into the 100,000 or so is nothing, and 500,000 or a million, which is very easily doable as far as the larger sizes are concerned. Let's see. Does the service work similar to a trade alert service, or you go into details of how much strategy it actually implemented? Does this work as a black box service? Well, let me explain what I think you're saying from that question, or let me rephrase that. Does the service work like a trade alert service? Well, technically trade alert services, well, here, we won't get into that right now, but you can always check to see what our trades are doing. You can log on at any time and see what the indicator says. So as far as needing to know like what our trade is doing and what trade we are going into that day, it is there. We also post what our results are, and after we've closed out the trades, so you can always reference to how your performance is if you're wanting to follow along. And as far as a black box service, I'd want you to probably define on what you mean by black box, because there's a few ways of describing that, whether it's an algorithm, whether it's a machine learning thing that we just kind of follow along, those types of things. But as far as what I think you're saying for a black box service, we still monitor it, and we still constantly adapt things going forward, and we still manage the risks as far as ourselves. So there's some human intervention as well. How critical is it to put on or take off the trades when they are announced? I.e., do you need to take the trade as close to it later in the day or the next day if the call is made near the close? So yeah, we trade near the close. We trade near at 12:50 or so for the service. Michelle is actually the one that normally enters all these trades, and she documents those things. My trading schedule is a little bit busier than Michelle's, so most of my entries are done normally about an hour before market close, sometimes as early as 2 hours before market close. And my results, will sometimes be a little bit different than Michelle's, but vice versa. Sometimes, those results will work out in my favor, and those results will work out in her favor. What we've definitely seen is, in general, we're pretty close to each other as far as performance is concerned. So if your trading time is a little bit different, or your execution is a little bit off from ours, it all pretty much washes out in the end. So I wouldn't say that you're going to necessarily perfectly align with us. We've got a few members that have reached out to me personally and said that they're dramatically outperforming us, which is always fantastic, because they've been taking a few intraday execution types of elements that they use in their other trading to make sure that they're getting the right structure at that exact moment. But that's not needed by any means. It'll all wash out in the end. As far as not sure, so this is the question, not sure if you address this with the question about account size, but what is the minimum number of contracts an SPX can be used on these trades? Can RUT be used? And if so, how many contracts? So this is an SPX system, and it is not a RUT system, even though those two systems do correlate with each other. Even though they do correlate with each other, they are not the same. So sometimes what happens, for instance, even right now, right? The Russell is a dramatically different animal because of what's been happening with these banks recently. And macroeconomics plays a very important role in the difference between small caps and large caps. I won't get too much into that today, but that's why they can be significantly different. So for instance, if I were to want to, make an adaptation of this system over to the Russell, the bearish side of things currently would probably be a little bit more aggressive than what we do have in the SPX. So I wouldn't necessarily change that. As far as the minimum amount of contracts that go into the SPX is one butterfly right now. As the volatility is larger because of how we trade, how we size our butterflies, as the volatility is larger, you end up having to put more capital in per trade because the butterflies are so big. One thing that I get into that with trading into small accounts, which there's a video on our site for that, is you can actually shrink the butterflies a little bit from their base width and still get, roughly speaking, the same returns to shrink the account size or to get a little bit closer to what the allocation amount is supposed to be. What is the format of the trade signals? Like I had said back here, which I brushed over it, the indicator actually looks like this. So you can log on, like I said, at any time during the day. It refreshes every minute. The earliest it refreshes, though, you'll see that this date won't actually be refreshed. The earliest that it refreshes is, I believe, it's about 9 o'clock Pacific time. That way we can get all the data we need and it can be pulled in and we know exactly what we're dealing with that day. And it will update. And then pretty much from after that, depending on whatever your trade time is, you can basically follow along. And like I said, sometimes I trade earlier in the day, sometimes I trade later in the day. It just depends on how my schedule is. Like clearly right now I'm talking to you guys. So my trades were activated really early this morning. But that's basically what happens. In other words, do you explain in detail what indicators you use or the logic behind them and all other implementation details behind each of the trading structures? So, great question. That is something that is very useful, and that's part of what I started to talk about here in this presentation as far as just the basics, volatility, making sure that you're stretched out. But that's about as far as that I'll go down that road. If you're someone that really wants to take this onto your own and make your own system for this, and you're that level of skill, and that's the road that you want to go down, then you just really need to find things that fundamentally impact your specific trades and your trading structures, and then you can go from there. I'm always willing to assist in that endeavor. But as far as sharing my specific calculations and my algorithms, I do not share those. So it's a service that you can follow with us and enjoy the returns and enjoy what it is. But as far as it educating beyond the risk management and the structures and the elements that we have, it's not going to go deeper into the models. Are most of your trades in a given week the same structure? Yeah, in general, yeah, I'd probably say in general, most of the time, unless there's an event or so, most of the time, the environments last for, roughly speaking, 10 days or so. So a lot of the times we'll be in the same structure for, a week and a half. And we'll slowly be putting them on and fading them off and things like that. So it just depends on how much the underlying environment changes. There's certain parts of the metric that don't shift a lot. I mean, something like the macros, right? As far as where we are in the macro cycle, that doesn't change overnight. That's typically very trendy. It changes over the span of months at a time or so. Well, those are all stellar questions. And, it's been great being able to talk with you guys about the system. And like I said, if you guys want to see more of it, you can do one of two ways. You can, I went too far, but I skipped right out of it. No, I skipped right out of my my PowerPoint presentation. Give me just a second here and I'll get it back up.
Okay.
That way I can show it. But basically, what I was saying here is that you can do one of two ways. You can either take the limited time offer, which, by the way, that limited time offer that ends as of next Wednesday. So it's a 1 week offer that we're putting out here for you guys. that you can get your 50% off for your first 3 months, or you can, of course, just try a 1 week free trial if you wanted to. The 1 week free trial is exactly what it is. It's free. And so you don't have to have any risk. You can just kind of go in there, see how things work, see if you like it and whatnot and so forth. And then attempt to go from there if you want to. Like I said, promo code at checkout, round table. All right, Tom,
Wayne.
how are we looking?
We're good. We're a little over an hour. Fed raised the rates as predicted, so market's basically back at the unchanged line. It's like +6 right now, so maybe rallying a
Perfect.
little bit going into the close, but not too much of a crazy reaction.
And
The
our
straddle
intraday,
price is still pretty high. It's a 45 almost. So
yeah,
so
yeah, it moved. It's doing a thing. I mean, I'd be interested to hear what Powell's saying now. I know that we're getting off topic, but I mean, yeah, the macros is concerned. I mean, we max gained on our intraday calendar literally as I was speaking on our presentation here. So yeah, the release that happened after the Fed announcement gave us our max gain. So it's interesting, actually above max gain now that I'm looking at it. But Fed releasing that they're going to raise 25 basis points, quote unquote, we're going to stop inflation. The market's pricing in that this was the last rate hike. So it's either the market is dramatically wrong, or the Fed is kind of, or the Fed's going to go rogue on us, basically, right?
yeah, on financial juice it says this indicates increases are near an end.
Yeah, I mean, that's the whole thing, is that we've been slowing on our tightening. I'm really wanting to know what they're going to be doing with their balance sheet, because any of you guys that have followed me on the macros is that their balance sheet exploded last week. So by 300 billion. And that was partly to, bail out some of the banks. That was partly to, do some other things. So yeah, in general, it's, the discount window is being used, and then they opened up this new lending, as far as trying to do that. So yeah, it's hard. It's a hard time for banks right now. It's just like what happened in '08. There's no difference except the fact that right now inflation is at 6% versus in '08 inflation was at like 1 or negative. So there was a lot of room for the Fed to be able to do some things. And now there's not as much room for the Fed to do some things. So this will be, like I said, one of those inflationary recessions. Yeah. And you didn't have any trades on, right, Tom?
I was flat. I sold some puts I don't know, a little bit ago. So it's the market's rising right now, so they're doing okay. So
Sweet. Yeah. I
yeah,
mean, it doesn't look like a very large move for for the for the
for the expected move, it's just kind of a fizzle.
yeah, and that's kind of what we're, for those of you guys that are in the adapt advance, I don't know if you're here or anything like that, but I mean, we had so much range on our trade that, we could handle a move all the way to freaking 5,000 if something happened. So it'll be interesting to see what they did with the options after this. And, I'll go check in on that after this is concerned. But yeah, gold going up, basically they're debasing the currency. It's just a way to debase the currency. And it's kind of sad because that means the dollar is going to have a rough time here.
Yeah. All right,
All
Wayne,
right.
let's wrap it up. Thanks everyone for coming. And there's the don't forget the roundtable promo code to get a nice discount. So thanks for the offer, and good job, Wayne, and nice results on your trade. So congratulations.
Thanks. It's been great. And yeah, everyone that's been with us in the service and been profiting from it's all been really happy. So it's a good service, and we look forward to many years in the future of some consistent returns.
All right. Well, thanks again, and we will see you guys next time.
Absolutely. See you, Tom.